Today's cardinal lesson, we're going to talk about long-term care and long-term care insurance, planning for the future. And I'm going to use an example of some people that are new clients. They're both 64. They're still in the process of making this decision. They came to us, both age 64, looking for Medicare supplement insurance, found our videos on YouTube. These are people that lived in California, and then they moved 3 years ago out to the Rocky Mountains. They're paying like $30,000 a year for their health insurance on the two of them, and they're very excited about going on Medicare with those Medicare supplements and the premium for those and the coverage that comes with that. And they're even going to have to pay a little IRMA. They're not too upset about that with the $30,000 that they're going to be avoiding. And so we got talking about long-term care. They're doing some financial planning with us. They wanted to accelerate this piece of it and take advantage of the fact of their ages. They're going to be 65 soon, and then that makes all these numbers a little bit more. So I thought they were a good representative case, although you don't need to buy as big of a policy as they're buying and considering. So you can just take these numbers on the sheet and just cut them in half. We sell lots of $3,000 a month long-term care policies with inflation benefit of 3% on there. And the people are a lot better off for having that coverage than they are just running naked and not having long-term care insurance. So the first option that we're considering, and I really think this is probably what they're going to end up going with, is the hybrid long-term care policy. So the term hybrid is, the bringing together of two things and making them one. So this was really created by the Pension Protection Act, which came around in 2007, and a tax law that allows money to leave a life insurance policy or to be withdrawn tax-free to make payments for long-term care. So it's the marrying of a life insurance policy and a long-term care policy and making them a combined hybrid long-term care. Okay, and I took the benefits for long-term care and I'm comparing it to a traditional long-term care policy with very similar, almost the same benefits, so that you can look at the money and look at the outcomes and really make a decision. Now, the $6,000 a month is $200 a day, and that is the benefit that they're going to have, both of them, for long-term care if it happened right now this year, which is not really very probable for these two healthy people that are very well-to-do and retired and semi-retired and living in the Rocky Mountains, hiking and all that kind of stuff. More than likely, if they use this, even 80 will be young, but possibility, and much more probable somewhere in the 80s and 90. And because this long-term care benefit has inflation on it, the benefit by the month when they're 80 for each of them is $9,628 a month, and it's $12,940 by the time they're 90. And if you turn this into the maximum that the policy will pay out for 4 years of care, it's $288,000 of benefit that's going to pay out if they were to use it starting right now, and they'll actually pay more because it can take 4 years, so it would be a little more than that. But this is just showing by the time they're 80, it's almost $500,000 each, and by the time they're 90, it's $650,000, and that's just because of the inflation. So you put those for two people together, it's like $1.3 million of long-term care protection that they're able to buy, so they're not having to use their assets for this. Okay, now what the difference between this policy and this policy, the main difference is this is a life insurance policy too. Along with being a long-term care policy, it is a life insurance policy which has a death benefit which is very similar to the initial premium that they pay. So the death benefit on this policy is $144,000. That means that if either one of them pass away at any time, not having used the long-term care, okay, they just didn't use it at all, their beneficiary is going to get $144,000. Now you say, well, that doesn't seem like a lot. Well, it's just about with the premium that they kicked into it. So this is kind of the, you either use it for long-term care or the money is paid into your beneficiaries for a death benefit. So this puts a feature, because a lot of people have looked at long-term care over the years and say, they know of instances, there's a lot of people that buy this stuff, pay the premium for 20 years, they die, and they never collect a dime out of it, okay? And that's kind of how insurance works. It doesn't make this bad. It just, people are kind of looking for a reason not to buy this long-term care insurance. And so I've been haggling with people my whole adult life over this. And, maybe haggling's not a good word because we're going to do what they want to do in the end, but I'm advising people. And it just seems like consumers, they really don't want to buy this stuff. And so they're just, the fact that they might and probably will get nothing out of it is a stop sign. And this hybrid long-term care, one of the reasons it was invented is either you, through long-term care, or your beneficiaries are going to get something significant out of this thing. Now, what happens when you start using it for long-term care, then that just whittles away at your death benefit. So if you are in using long-term care, it's for a period of years, it's substantial. Well, then with this policy, there's no way to use up the whole $144,000, because if you use it up for long-term care, there's still a residual death benefit of almost $29,000. So no matter how much long-term care you use, at the end of this thing, it's still going to pay a beneficiary $28,800. So that's the residual life insurance benefit. So, I mean, it's pretty cool. Now, for the misses, ladies pay a little bit more than men do because they have a greater chance of using it. For long-term care, they don't have a greater chance of dying, but they have a greater chance of using it for long-term care. $152,000 is her premium. His premium is $140,000. And so you put those two together, you've got $292,000 that they're going to pay for those two separate policies in a single premium. Now, if they chose, and they didn't really ask for this, but I can show you if this is of something of interest and you didn't want to put out that kind of money, then this could be split up over like 10 years and there'll be an interest factor added to 1/10 of it. So we could get into the numbers on that, but this is the downstroke in the beginning, and they've basically bought $288,000 worth of life insurance, half on him, half on her, through the two policies. And if one of them goes before the other and doesn't use it a lot for long-term care, then the surviving spouse is going to be the beneficiary. And we usually set these up so that the children, or the adult children, are the contingent beneficiaries. And when this actually happens with somebody, we're going to sit down with the survivor or the surviving spouse and say, do you really want this money? Because if you want to disclaim, it can pass to your kids. Well, sometimes they need the money. So in any case, we can set that up any way you want it. Now, this is the hybrid long-term care. Now we're going to talk about the traditional long-term care a little bit. In the traditional long-term care plan, I've written tons of these policies, and I've had lots and lots of people collect on these. And this is the place to get the biggest bang for your buck, or you can get started on these with the least investment. So, and there are still a number of companies that offer this. There are less. And we've got these available in all 50 states and the District of Columbia, this and this. So, we work all over the United States. So if you want to get your own personalized thing after we talk to you a little bit, no problem. May vary a little bit from these depending on what state you're in. But this traditional long-term care policy, the benefits start at $6,000 a month. At age 80, it's almost $10,000 a month. It's grown to that amount. And at age 90, it's $12,940. is what it's grown to from the inflation benefit. There's zero death benefit on this. In other words, you pay the premium for this and you're both killed in an accident or something at 80 years old, all that money that you paid into the insurance company, your beneficiaries are going to get none of it. But understand that money has gone or will go to pay the claims of the people who collect way more out of this thing than that's the insurance principle. So now you've got several options to pay for this thing, but the premium is almost $10,000 a year, $9,885, where you will pay that for life. Now, when one of you dies, that premium will come down. So if this was a couple buying it, because this is covering two people, but you pay that for life. And the company could raise the premium on that. Now, this is in the modern era, premium increases on long-term care policies are post the problems we had with that like 10 years ago. Companies are very restricted in terms of how they can raise premiums on policies, but they absolutely can do it. And so just know that. The second thing is, the second option, which I'm showing, and there's many more than this, is this particular company has a 10-pay option. And that means that if you want to pay the premium and have it stop after 10 years, you pay $21,647 a year. So by the time you're done here, you've paid $210,000. But then you can't have any rate increases for one thing on that. That's guaranteed when you're on the 10-pay option. And then the next thing is you also, you're done paying the premium after 10 years so that people can foresee, so they don't get into very old age and they are figuring that, what if I can't pay the premium? Well, that kind of eliminates that. Still substantial amount of money on any of these options, but what we're talking about is a substantial risk here and a substantial payout. Like if long-term care happens to you, you really want to have this insurance, whether you've got the money or not. And as I suggested earlier in the video, I said, look, if these numbers are too big for you, cut everything in the board in half. I mean, if you're turning 65, or if you're just one person, you can pretty much cut the premiums in half, and you can look at that of just buying it on one person, and you could cut it in half again if you would take the starting benefit down to $3,000 a month, which is still substantial. Now, there's one other feature that I just kind of left out till the end here that I want you to explain to you the difference between an indemnity policy and a reimbursement policy. Now, there used to be traditional long-term care policies that were actually indemnities, but no more. So the reimbursement policies, what that simply means is if you go in assisted living or you have a home health care aide come out and take care of you 7 days a week, and the bill for that 7 days a week is $100 a day, and it's $700 a week or $2,800 a month, and you've got a $6,000 a month policy, you get $2,800, okay? And then that remaining, $3,200 that you didn't use, it stays in your pool, so it could make the policy pay longer. So it's not like it's gone, but you're not going to get paid a dime until you prove that you spent a dime on your care. It's a little easier with assisted living. So that's a reimbursement policy. This particular one that I'm showing you is an indemnity policy. And what an indemnity means is if you qualify for the care, it means that you couldn't do 2 of the 6 activities of daily living. And what I find in experiencing and working with people that are filing claims, the 2 simplest to prove for home health care is I need help bathing and I need help dressing. I need substantial human assistance with both of those. Those are 2 of the 6 activities of daily living. You meet the standard of care and you set up a plan. They don't care who helps you with the bath and who helps you get dressed. I would suggest that you don't have your spouse doing that, because spouses get worn down when the older age, and that's really what happens when people don't have insurance, is you have the one spouse who may not be in the greatest shape, period, taking care of the person that needs help. And then after a while, you got two sick people. So I don't recommend that people cut short on the care. What I'm saying is you don't have to mess with, when you have an indemnity care plan, these people, and what they're interested in doing is just hiring privately somebody to maybe come in and live with them. They have a very big home out in the West on a mountain, and they would bring somebody in, or maybe it'd be two somebodies that they would have work with them privately. It might be a relative, it might be one of their adult kids, and then this money is just going to come in tax-free. And once I sit down and explain this to the gentleman and his wife, I think what he might end up doing is, instead of the inflation, just buying the $10,000 a month right from the start. You say, well, that's almost double that premium. Well, not necessarily, because when you knock the inflation off, that costs a lot, is to have increases in the long-term care into the future. And you just bump that up. That'll also increase the life insurance. And then that just means when he needs care or she needs care, or they both need care, in comes a check for $10,000 every month, and that check is tax-free. And once people start to take a look at that, so again, don't let the numbers scare you. We can sit down. We have about 7 companies that offer this kind of stuff. And we've got 4 different companies that offer the traditional long-term care pretty much all over the country. Maybe we're a little more limited in New York, but we have options in New York. So, like I said, we would sit down and we're going to recommend, we're fiduciaries, we're going to recommend what company and what benefit level that we think you need. Now, it doesn't mean you have to buy what we recommend, but we're going to create a recommendation, because we're fiduciaries, that is going to be in your best interest. So, and that could involve a lot of companies. Now, saying all that, I didn't want to throw this third option up on the board, but there's a lot of people, especially people that have this kind of means in retirement, that have just continuously rejected long-term care. And they've done it on the basis of, look, I'll just pay for it myself. I don't want to send that amount of money to an insurance company. And so what they're doing when they're 64 is they're talking about how their future self, their 85-year-old self, is going to respond to their adult children who are in their 60s when they're not in good health. Okay. Sure, they've been managing their money and they're just saying, okay, I'll pay for it myself. I got lots of money. Okay. That doesn't look too pretty. I've been in that situation so many times where I've been there. The adult children who are about my age are bringing me in there, and we got dad who's being a little stubborn, and the kids want to bring in some care from the outside. And I've got one situation just comes to mind immediately. This guy had lots of money. He threw them out. Once he found out how much they were paying, he waited till his kids left. He threw them out of the house. He just said, leave. He found out they were $25 an hour, and his thinking was all they did was watch TV. Well, sure, they were turning on the TV or whatever. I mean, that's another issue. His point is he didn't want them there. And he was saying because of the $25 an hour. So what I'm going to suggest is, and I do this for a lot of affluent people, after they've looked at this and they've rejected, we have a thing called short-term care. And a short-term care policy is going to be much less expensive than this. It's going to look more like this. It doesn't have a death benefit, and it has 1 year of benefits for either home health care or nursing home care or assisted living. And you say, well, what is a wealthy one? Why do I just need a 1 year policy? Listen, the 85-year-old guy who's being stubborn, or his wife who's being stubborn, that's 89 or whatever, they're much more for having those people come in if the insurance company's paying for them. I mean, and it gets people started. And another question I have for these wealthy people that are going to pay for it themselves, which investment fund are you going to take it out? How much does your daughter know about tax planning and all these things you've done. Are you going to take it out of the IRA? Which stocks are you going to sell? So a short-term care plan, I would recommend that in place of one of these, if once you've rejected this, simply as a, let's kind of get the program started where the people aren't objectionable, and that gives us a year to redo all the finances so we can just cut checks to the people. I'm Hans Scheil, and I thank you for listening.